Hey friends, welcome to our 2023 Outlook and our weekly outlook for the first week of 2023. This is from the team at TRADEWITHPROFILE as part of our Markets and Profile and the beginning of our foray into 2023. Hi, I'm Josh. This is part of the start of our development work each week as a team. We're a development firm that works with active traders looking to express ideas in an intraday time frame, but even though you may be active in an intraday basis, we look at kind of a larger view each week just to kind of ground us in what's happening in the larger macro narrative and make sure that we're in keeping with that. And so, we do that on a week by week basis, but given that it's the beginning of the year, it's a great time to start looking at kind of where we are from a overall perspective. And that's what we're going to do in this video. So, aside from our weekly outlook and ideas around the products that we look to express ideas in, be it NASDAQ, ES, Russell, and Crude Oil Futures. We're also going to kind of take a broader view, kind of where we are in markets and how that's going to impact our expectations for the year ahead. So with that, just invite you to grab a pen and paper. We're going to sit down here for the next 25 minutes or so and look back at 2022, look ahead at 2023, and have some fun, shall we? So with that, typically where we like to start is by talking about kind of a macro perspective of where we are and what's kind of in play, and all of that is largely driven by this chart. And so I'm going to actually turn off some things here. We're going to talk about kind of what's happening here on a macro perspective, and the biggest story that's been in play has been this one. So this is the inflation rate that has been the dominating narrative for 2022. It will continue to be a narrative for 2023. We are, as you can see, it seems that we have now approached a peak in inflation. However, note, relative to where we were for the prior number of years, we are still 400% above where we were back in 2016. So yes, maybe we've hit peak inflation. Is this going away or not impacting us? No. So this is going to continue to be in play. Now, there's other things that are in play around this idea of peak inflation that is impacting equities. Now, obviously, as inflation has gone up, that has impacted what's happened on equity prices. That's not the only thing that has impacted equity prices. Two other things. One is that the largest explanation for why equities had moved so much higher over the last 15 years is really what we had called a monetary market. And so this line here represents what we call quantitative easing or Federal Reserve Bank activity to encourage people into equities. And obviously, this just took a massive spike higher in 2022 as part of the response to the pandemic. And now we are in a phase of what we call Fed tightening. So you can see now that this is now the Fed is reducing their amount of stimulus into the market. If you've heard the term quantitative tightening, that's what this is. This is also tied to this chart. Now, this chart represents how much of Treasury debt is held by the Federal Reserve. And you can see during COVID, this spiked. It's now coming back down. We are reshuffling the balance sheet. And what that means is that it's going to continue to impact negatively what's happening in equity prices. And, why is this? What's kind of the fundamental, driver around this is that as inflation goes higher, a couple things have to happen. And let's just kind of get over here to a story. Okay. So as inflation goes higher, so if this is inflation, there's really one singular thing that the Fed has to combat that, and that is to raise interest rates. And they're trying to shut off demand, right? The demand so it's some of that just fundamental macroeconomic stuff that of like supply and demand, and the macro perspective being that you're introducing monetary policy from a central bank to inform that. Well, how does this impact equity prices when you raise interest rates to combat inflation? Well, you're increasing the rate that people have to pay to do what? Borrow money. And a lot of corporate companies, especially large tech companies, are using corporate financing to fund operations because they're not just like doing capital operations by cash. They're doing it by financing it. And for a lot of times, this has been a really effective approach. However, as those interest rates go higher, right, the percentage of that interest rate goes higher, that in terms of what it costs, so the dollar cost value of debt means that the earnings per share, or the price to earnings ratio, goes down. Because if I have to pay more to finance operations, I have less left over for earnings per share. And this is why companies are guiding lower as interest rates continue to go higher. And we're still expecting those rates to continue to go higher throughout 23. So this is, part of, the expectation of what's happening on a macro perspective, and something that we're paying attention to. So, last year, at this time of the year, we were talking about the transition out of what we call a monetary market into a fiscal market. You can see that kind of, happened at the beginning of 2022 and is played out about as we expected. We're not done. So we're going to continue in this narrative. It could be this year, could be several years. But it's going to be one where it's hard. So, for those out there who are like, hey, we're going to, we got to buy the dip and all that kind of stuff. This may not be the one to buy just yet. So we're going to be watching the Fed, and we're going to be watching what they're doing overall to get a perspective of what's happening. Now, some other things, macro that's been happening is because of just still working out things from the last 15 years of monetary policy, plus what's happened with COVID, just looking at performance last year of different sectors of the S&P 500. Energy was the big winner. Tech was the big loser. So, one thing to think about as you come into 2023 is, okay, what's cheap relative to the S&P? So the S&P's here, right? What's expensive relative to the S&P? What's cheap relative to that? Tech is cheap relative to the S&P. It's also one of the things that's driving the S&P lower because of the weighting of some of these large tech companies that are in the Amazons, the Teslas, the Apple, and so forth. However, something that we're going to be watching is that when a turn happens, when we get a short-term bottom in 2023, which I believe we will, we're going to be watching those companies as an opportunity to get some pretty good opportunities. So if you are looking at single stock investment, be watching those companies as the places that are likely to turn first as we come into 23. So that kind of gives us a perspective of what's happening in the macro environment. Nothing's really changed from where we are. We are, this is the end of the beginning. It is not the beginning of the end. So we are still very much in a fiscal market, and will continue to be so for some time. It just means, hey, the playbooks that people have used for a long time are not going to work. For us as intraday, active traders, it's less of a concern. For the long-term horizon investor, it's going to be a challenge, and it's one where we're looking to be mindful of. Other things, just from a macro perspective, and actually, what we'll do, we're going to talk about this when we get to the ES. So let's jump now back over and talk just kind of like this week, what we're looking to do in terms of the calendar and things that we can look for ahead of us. So this week's a holiday week, shortened week. Monday is a holiday. It's the observed holiday for New Year's Eve or New Year's Day. There will be no trading there. Tuesday, we have a manufacturing PMI that's going to happen right after the open. I avoid the first hour of the first day of the year like the plague. I'm going to drink coffee. I'm going to read. I'm going to come in and let this thing decide what it wants to do before I take any opportunity. If you want to lose money to start the year off, be my guest and trade right off the open on Tuesday. Let this thing set up. Wednesday, we've got ISM manufacturing. So again, because that inflation story is still there and that's what's driving Fed activity, we need to be mindful of those when they're happening. That's going to be right in the middle of the initial balance. So be mindful of that. Thursday, we've got jobless claims before the open, trade balance. We do have services PMI after the open. And then crude inventories are on Thursday as opposed to their typical Wednesday. And then Friday, we have non-farm payrolls. That is important because essentially the Fed is looking for us to take a ding in employment as a way to signal to them that they could be more accommodating and keep their, get their foot off the gas. Right now, they're still keeping their foot on the gas, and that's proving to make things difficult. So with that being in mind, let's now start going through the specific products. And we're going to start here with the S&P and get a picture of what we're looking to do there. So we're going to start here. I've basically pulled this up to the end of 2021 and just talk about like what we were expecting last year and kind of how that played out. Had talked about last year that after the end of the year, noted that, in this run up from COVID, okay, and this is why we look at, even on a long-term basis, a long-term composite profile. Now, they do not come into play very often. However, it was very insightful as we came into 2022. And that was that from, kind of a 1920 area, you can see how large the composite was at 285 and how thin the profile was. So, two key concepts within auction behavior is that moves begin from balance and they end in excess. Well, what were we? We were balanced in inventory. That's this, build out in the profile. And then we are exhausting. How do we know exhaustion? Is that we're running out of inventory as we move higher. So the best case scenario was that we would trade sideways in 2022 and try to, build out the profile this way. From an expected range standpoint, we had a potential high at 540 and then a low at 390. That was the range that was projected on the 31st of 21. Most traded price of 2022 right here. The trailing VWAP from COVID, the year-to-date VWAP from 2021 down there. You can see lots of things trailing the inventory and the auction closing on the highs. So would expect balance in the year. Let's see how that kind of played out. If we exit here, and that will take us up to where we are now. And we can see, what were we looking at for the low? We were looking for 390 was the expected low, 382.43, pretty close. Also note the difference in what this composite looks like. Look how we've been building out the profile here. Okay, so the auction is trying to accept these prices, and it's very possible that this year, we continue to build this out. Now, however, I will tell you that the current projected expected range for 23 is 292 to 470. So this is the expected range for 23. And given that we've been in a little bit of a pocket here around 382, what are some key references? Well, we have 430 above. We also have this composite node at 320 as, pretty interesting places. Overall, if we go and look at the profile for the year, let's add this year's profile. Okay. What's going to be kind of the key price? And that's going to be right here at 390-ish. In fact, that is right around 395 SPYs. That's the most traded price for 23. Below that, and note how this is actually got a skew. So we would call this imbalanced, which also supports why I believe that we're going to still go lower, given kind of the macro narrative, is to get this thing balanced, where we get to a bell curve based on where we are. We would be trading back in this direction towards that 292 area. But 395 is going to be kind of the key reference. As we start the year, we'll look to see, do we push up, test some of these prices, and then do we roll back over? Then I think we're on a direction down here. If we make new yearly lows and then come back into this, 395 is going to be the first destination, and then we would start pushing toward that 470. I think that's a scenario that could happen, like once we get to I actually, looking for us to go lower to begin the year and then turn back in this direction and push and finish the year fairly strong as the Fed starts to roll back, if they get to play out the way that they want to. Okay. So that's kind of the overall perspective of where we are now. As we often do, we go and look at the VIX curve. just to give us an idea of, kind of what we're looking at in terms of positioning. And, this also kind of speaks to that the belief that we're going to still go lower is that although we ended close to the lows of the year. In fact, we were right off of the 2020 high. We were below. Here's that 2022 VWAP. Here's the 2021 VWAP. So basically, anybody that bought in 2021 or 2022 has lost money on a weighted average basis. If they bought since the COVID low, they're losing money on a weighted average basis. That's a lot of buying to be underwater now on a volume weighted average price. Looking for the auction to move lower. Why? Because we have a complacent curve. Now, on a short-term basis, we're close to an inversion, but on a combined curve, we are not anywhere close to being in a spot where we've got enough fear to give us a bottom. So, I believe that we're going to be pushing lower, but to begin the year, maybe get into the 340 area, get kind of an initial first bottom that then takes us back in this direction. So we're very, very susceptible to the downside as we begin the year. Now, let's dig into more of a macro perspective of what we're looking for this year. On this larger stuff that we've been looking at, now when we go look at kind of what we look at on a typical basis, it's going to get it's going to feel really small time frame. But we're looking at monthly profiles here. Closed December above, one time framing higher for the month. However, volume is to the downside. So we have a skew here. We have a balanced profile or balanced posture. We're going to be watching this 38.65 area as 38.60 as the place that, that we're looking to go. Weekly expected high, 39.50. Weekly expected low, 37.60. All right. So we're looking for a move from balance in one of these directions. However, given how imbalanced we are to the downside, we're going to be looking for us to push in this direction. We are in still the CPI range from November. That's what this box is, giving us an idea of that. Looking at a weekly basis. So let's push here just a little bit closer. You can see we're just really balanced in this range. Moves begin from balance. So, it's going to be an inside out trade. We did close with some strength. So we could push higher to begin the week and then see if that, takes us back in this direction later. But, one of these two prices is, the expectation for the week. We could get up to test December's volume weighted average price, but we're going to have to kind of wait and see as the week plays out. Looking at this on a TPO chart, this also just shows you how balanced we were to close the year. Very balanced week to, as the last trading week of the year, very much in the middle of the muddle, right around the 5-day. We would expect that we're going to trade higher toward the naked VPOC on Thursday. And above that, we can push toward 3,900. However, if we're, back in this direction or below 38.44, we could challenge those lows. So, to start the week, we're going to be balanced. We're looking for pushes to the edges and see if that gets any acceptance as we start the week. Again, we're going to be really kind of paying our attention to just wait and watch as we go ahead. All right. That takes care of the ES. Let's look at the NASDAQ now. And we'll do kind of a similar perspective looking at the NASDAQ here. All right. And we're going to use the Qs as the primary vehicle. Here's what the profile looked like at the, on the composite, right? Same thing. Look how thin it was relative to where value was as we pushed out into the year. Now note how this composite has filled in. So this is the auction backfilling. This is very natural that this should have happened. Again, however, we are definitely below year-to-date, 200-day moving average. We're in a place where we could, push from kind of 280 up to 320. Or 210. This also looks imbalanced to the downside. Watch 280. That's going to be kind of the, the key pivot point. Below that, we're looking for new lows. If we push lower to begin the year, I like the rally later in the year. I think that provides some really great opportunities. So if you want to buy, that's great. I think we're going to get lower prices as an opportunity to go. I hope that the lows come early in the year, not later. If we push higher first and then push this way, kind of the way the auction works in terms of like, which do we do first? Do we rally first and then go lower? Do we go lower and come? That tells us kind of how we'll end. How an auction begins is how it ends. If we rally to begin the year and then come back through this, that sets up a stage to move lower towards the end of the year. However, if we move lower to begin the year and come back, then that can set the stage for us to go in this direction, all right, which we would much, much prefer. As far as what we're looking for on the long term, all right, let's look here at the monthly. We're below the CPI from November. Poor low for the year. NASDAQ, a little bit of a kick save to end the year, but this is poor lows, no really good low. We are below 90-day VPOC, and we're fairly balanced in our posture. We're going to watch out of this direction to see, do we go lower first or higher to start the year out? But it's definitely not a great spot to dip by. If we go higher early, great. That's an opportunity to sell. Certainly the way that we closed on Friday back at the 5-day after pushing lower early in the week, I think there's an opportunity for us to push higher early in the week. So beginning the week early, that makes sense. We get beginning of the year inflows and then fail back later in the week to make new lows, especially if non-farm payrolls plays out that way. Looking at the TPO chart, much like the NASDAQ or the ES, you can see just how balanced we are from one day to the next. We're just in a balancing range. Okay. So we're going to look for inside out from the 5-day this way or this way, and then see how the edges hold. But looking at that larger perspective, there's definitely more susceptibility to the downside moving significantly lower. Be watching the quick sheet, which you can get access to, this document right here, to see where those expected ranges are. I mean, we're looking for about 446 points, 11,334 to the upside, 10,709 to the downside this week. Okay, so that is the NASDAQ. Let's talk about the Russell real quick and see what's going on there. We will do that via the IWM. So the reason I'm using these ETFs is because unlike futures, the ETFs do not roll. So we don't have like adjustments between roll periods. What are we looking for in the Russell? Okay, the Russell did ultimately break out from a area of balanced, and then now is doing what? Most likely is going to come back to 150 this year. This should support the auction. I think that's not a place where we can find some buyers to be re-engaged. Same story. If we move higher to begin the year and then push, I'm looking short essentially to 150, below 150. Then we're looking for buyers to step in later. If 150 fails, that could be a little bit more dicey. As far as the specific product, let's just right size this, shall we? All right. You can see from just month to month basis, we're just really not going anywhere. Several times we tried to get above the year-to-date VWAP, unable to do that. Closed with the month lower in December. Most traded price right here at 1755. That is going to be kind of our key pivot, higher or lower, but we've got poor lows. I'm expecting these lows to be tested. I think if we get higher prices early, that's an opportunity to get better trade locations short to come later. Looking here at the weekly, very range-bound trade, right? Inside out. Watch the edges. Early rallies that come back through this area, we'll look to make a charge down this way. If we push lower and come back, then I think we can move in this direction. Pretty straightforward overall. Looking at the composite, you can see we're just balanced. Back and forth, no clear direction, waiting for the new year and new year inflows for that to be in play. But could easily see this trade to 1733 or up to 1805 this week. Very, very reasonable as we look at the week ahead. Again, beginning of the year, let the thing play out and come to you. Finally, crude oil. As we like to look at the crude and get a perspective on what's going on there. And we're going to go look at the yearly here. Big breakout year last year, early in the year, and then failed. Here's the most traded price. We did come down and test the most traded price from the prior year, and that held. For those that want to be long crude, you want to get back above 88. And that's going to be a key level to get above for the year. I think below 71.59, and we start moving back towards 56. One time framing higher overall for the year, and could ultimately make a play, back up here towards the 110 areas. But your first hurdle is going to be, you're going to have to get above 88.50. So any early longs in the year, if you're from a swing basis, you're looking for 88. I think that's a nice clear target to the upside. But if we break those lows, one scenario could be is that we break the lows and then we come back above those lows, and then you're looking for a long in that direction. I think that could be attractive as well. Looking at it from a smaller time frame basis, let's look at a weekly or a monthly. I'm sorry. Just get this to load up real quick. Thinking. Well, is our weekly or just here? Well, we'll just start here. Price equal to the 5-day. You can see the 5-day is right over here at 79. A little bit of balance to begin the year to break out of. Watch 79. That's kind of the key reference given, and as well 78, which is 78.20, last week's most traded price. Above that, we're looking to push new monthly highs. Below that, we'll go in this direction. Let's see if that data has now loaded yet. There we go. Awesome. So here's the 5-day, 20-day below. As long as we're above the 5-day, we're kind of free to fly and push up toward 82.50. That quarterly VWAP above there could start making a way toward that 88 area that we just pointed out in the long-term chart. However, if we lose the 20-day, watch for us to make and challenge these lows that came in. The December traders traded below November, got back above that, traded back towards the middle. Overall, for the month, I think it's pretty encouraging for the buyers. Closed very close to where we opened. If I was looking at that as a monthly open high-low close bar, it would look like that. That's good buying excess, and that would suggest that we would look higher. So as long as we're above 76, we're looking for a push towards there to start the year. However, if we challenge that, then those longer-term perspective is in play. Okay, so that's what we're looking for as far as that goes, and see how the week plays out. Again, remember we've got EIA on Thursday, not on Wednesday. That leads us now to just kind of talking about our development focus for the week, and that is to go slow to go fast. This has been a mantra on our development desk and something that we talk about all the time. And it's really, hey, when it comes to a new year, don't be in a rush to jump in. Force the auction to come to you, and as you're reflecting back on your trades, mark trades that are FOMO. It's remarkable to me to the number of times that when I'm reviewing a trader's trades, if we just eliminate the ones that are FOMO. And what do I mean by that? It's like they took the trade. Why'd you take the trade? You just wanted to be in something. Not because it was a playbook trade, not because it was something that you had really kind of worked through in your process. It was just like, I need to be active. And that almost always dings your performance. So if nothing else, just as a practice, if you want to go through and just click off, hey, that was a FOMO trade. That was a FOMO trade. That was a FOMO trade. Remove those from your performance. I think you'd be shocked at how much better your overall equity curve would be as you go ahead. The next step would then be like to go through and look at all of them from a playbook perspective and say, okay, which playbook trade were these? And then sorting them by playbook to see where your perspective is. And then I think you get into a better spot. But that is the perspective this year or this week that we're really going to hone in on. It's like going slow to go fast. We've got the whole year ahead of us. We can be picky as we get started. Other things to think about. What is a playbook trade, for example? You can use 4 questions to spec out your playbook trade. So if you're curious if a setup that you're using is a playbook trade or not, go look and see what those 4 questions are. We'll be back active on Twitter this week, sharing updates and looking for ideas. If you want to get a fresh start and schedule an insight session with us, we reserve some of these each week for you to just get feedback on how your trading development is going. There's no risk or commitment other than the time to you, and we'll give you at least one concrete idea to take away from that. If you want to do some more intentional development work, you can do that with our development desk via one of the pathway options. You can find more about those at tradewithprofile.com/pathway. And then as far as platforms shown here, I didn't look at anything on WindowTrader this week, but the platform we primarily have shown here is Edge Pro X. You can find more about that at edgeclear.com. And then finally, for those of you who are part of our development pathway, we'll see you in Slack this week for our weekly development sessions. Really excited for the week ahead. So congratulations, everybody. 2022 is over. 2023 is upon us. We're going to go slow to go fast. We're going to jump into the week and have a lot of opportunity. We'll update everybody how that went once we get to the next week. Thanks for watching. Thanks for sharing with your friends, inviting others to follow along, and we'll talk to you next week. Peace.